I'm Matt Bishar with NAREIT.com. I'm here in Washington, D.C. at the Marriott Marquis Hotel for REITWise 2016, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Ross Prindle, Managing Director with Duff Phelps. Ross, thanks so much for joining us.
My pleasure.
Now, here at REITWise, you were on a panel that focused on the public non-listed REIT market. Can you talk briefly about FINRA Notice 15-02 and the impact it's had on the market?
Yeah, there's been a very big change for the REIT market on 1502. Previously, the REIT market had waited until the end of, they were selling shares, and there was some time period after selling shares, closing selling shares, where they would have to go back and report to their investors through customer account statements what the NAV per share is. And with 1502, now they have to do it within 2 years and 150 days after breaking escrow. So, and then annually after that, which is essentially a big change for them, because you could go through the selling process, could be 3, 4, 5, 6 years, and then close your fund, and then finally report a new NAV. And while the whole time of selling shares, you could keep it stagnant on the customer account statement at $10. So. And obviously there's ebbs and flows in the real estate market. Values go up, values go down during that time period. So I think the regulators were more focused on, let's get some transparency out there. Let's get a little bit more quick valuation of these shares onto people's customer account statements, and that's really going to have an impact. And you're seeing it in the fact that all of these non-traded REITs now are hitting that time period where they're going to have to do something. So it's a very active time for them to get their share prices out onto the customer account statements.
Now, looking ahead, what do you see as the biggest challenge or opportunity facing the public non-listed REIT?
Well, it is 1502 in my opinion. The other thing that was salient as part of 1502 was, if you don't revalue your shares, if you're within that 2-year period from breaking escrow, you have to report shares after operating expenses and originating expenses. So I'll give you an example. So if you're selling a share at $10, your invested public puts in $10. The next quarterly statement they get that says $8.50 or $8.25 or $8.75 or whatever the difference is in the expenses are there. So, which is kind of an interesting thing to educate the investor on, if you're a broker-dealer or registered investment advisor, on that your shares you've invested $10 and within the next quarter they're only worth $8.50. So it's having a little issue of education, and it's already starting to hurt fundraising a little bit.
Shifting gears completely, talking about the CMBS market, how do you assess the current state of the market to be able to handle the capacity to refinance the wave of CMBS that we expect to come due in the next couple of years?
What usually happens in this time frame, either something gets fixed within the CMBS market, which that may happen and may go back to the way it was, and spreads will tighten and people will start understanding how to price the bonds, and they'll be able to lend again. Or you're going to see other lenders come in and fill the void. You're going to see insurance companies come in. You're going to see other money center banks and even private equity, other debt funds. Those type of vehicles will come in and fill the void, in my opinion. I don't think anybody's going to see a big crisis where we had a while ago, where no one could get debt and it put a stagnant on the real estate market. I don't think we're going to see that. I think we're too mature, I think, and we've been through this before. So I think others will step in to fill the void if the problem doesn't get solved in the short term.
Ross, thank you so much for joining us.
Sure, no problem. Thank you.
For more from REITWise 2016, be sure to visit REIT.com.